All right, Mahesh Nandurkar joins us. Let's connect with him and talk about which way they feel markets are headed and how long will this party continue. Mahesh, good morning. Thank you for joining us. What is your view on the market and what exactly are you communicating to your clients after the union budget and ahead of US elections?
Hi, good morning, Nikunj. Yeah, so what we've been communicating to investors and what has been our strategy is that over the last couple of months we have toned down the risk or the beta factor in our portfolios. We are moving some part of the money from small cap, mid caps into the large caps, turning a bit more defensive from a near-term perspective. I personally believe that the economic growth driven by investment cycle is very much on a strong footing. But from a near-term risk-reward perspective, I'll, uh, I'll side on the lines of being cautious here. Because we are clearly seeing that the domestic retail activity is at a very high level. In fact, in this calendar year, the first 7 months or first 8 months for which we have the data, we are seeing the total domestic inflows into the equity market from all sources, be it SIPs, be it mutual fund, be it direct stocks, is running at about $7.5 billion a month, which annualizes to almost $90 billion a year. And almost like 25% of gross financial savings, 35% of net financial savings. It's kind of going into the territory where we see these kind of numbers from the developed market. So I believe there is an element of unsustainability to these strong domestic flows that we're seeing. They need to come down a little bit, in my view, and therefore we are being a bit cautious here.
$1 billion, could you give us a breakup? Because we are accustomed to only look at 22,000 crore, 23,000 crore of SIP flow. $7 billion is roughly, let me do the math, 7 into 9. ये तो बहुत ज़्यादा है. It's a very big number.
Yeah, so if I just stick to the billion-dollar numbers, then if I just give you the split, roughly $4.5 billion of mutual fund inflows, every month. On an average, I'm saying, the first 7, 8 months, which roughly translates into what about 45,000 crore or something, and then another 1.7 to $2 billion of net inflows coming into single stocks, which is the individuals or the retails of the HNI buying the shares directly. That works out to about 1.7, $1.8 billion. And then another $1 billion or so is coming in from the EPFOs, the NPS, the insurance, etc. So that's how we add up to about 7.5. So 4.5 plus 2 plus 1. That's the rough maths.
Outside the syllabus, but I'm quite curious to find out what is it that you make of the regulator issuing very stern warnings and raising red flags. Their study yesterday found that 70% of individual investors sell their IPO shares within a year. And what they have to say about SME IPOs, they're saying that promoters have been creating unrealistic projections post-listing and then sort of booking out of that. Do you think there is a bubble in the making here in the IPO market, in specific in SMEs?
Yeah, I mean, what we are seeing in SME market is, clearly, something that we've never ever seen before. And we looked at some of the recent news flow in terms of a small IPO, kind of trying to raise about 11, 12 crore, getting subscription worth about 5,000 crore. So clearly, these are all signs where we are seeing, excessive exuberance in certain pockets, of the market. As you rightly mentioned, SME probably looks like one. Uh, but I think that could be applicable for some of the small cap, mid cap names in the main market, as well. So yeah, I think the regulators are warning the individual investors, around this. But I guess at this point in time, what is really working is, things are looking good. People are making money, and that's why one is leading to the other.
Mahesh, morning. You also had all of the data coming in when it came to the entire auto space, and I'm just curious to get in your thoughts as to how you've read into them and what that could potentially mean for the entire sector as a whole in the long haul.
So on the auto side, we clearly believe that two-wheelers, as a sector is looking like the best sector to own here. if you just look at the industry volume numbers, the current year FY25 industry volumes for two-wheelers are more or less in line with where we were back in FY19, which is pre-COVID. So two-wheeler industry volumes have barely crept back up to just at the pre-COVID level, where you can easily see that most of the, in fact, nearly all other industry parameters for other industries, we are easily 30 to 50 or 60% higher than the pre-COVID numbers, where two-wheelers are just at the pre-COVID levels. So clearly there is a lot to catch up there. We believe that a strong double-digit growth for the industry is very, very likely this year, next year, and maybe the year after as well, because there's a long wait to catch up. So two-wheeler clearly looks like the best segment to own within autos. In fact, I would say not just autos, within the overall market, in my view. The tractors, seem to be, the second, where we're seeing some signs of recovery. So those are the two segments, sub-segments of autos, which we like.
Mahesh, but it absolutely amazes me that when urban economy was doing well, rural economy was not doing well. Now we are seeing signs of slowdown in urban economy, rural economy is doing well. When cars are selling, two-wheelers are not selling. When two-wheelers are selling, cars are not selling. It's quite contra, isn't it?
Yeah, I think we go through cycles, right? So there are cycles on the urban side, there are cycles on the rural side, there are cycles on the consumption side versus the investment side, and so on. So by and large, our core thesis is that as far as the long-term cycles go, and these are 8-10 year cycles. So our core thesis is still around the positive trend on the investment cycle, which is basically why, from a long-term perspective, we still like the real estate, the infra, the manufacturing, etc. But some of the stocks, have run up quite a lot. So maybe one needs to be a bit cautious here. I think maybe the reverse is happening to some extent, on the positive side. That's on the low ticket consumption or the rural consumption, which showing some initial signs of recovery. And there are a few stocks which have been laggards, which include staples, which include some of these two-wheeler names to an extent, which should do well. And yeah, that's what our view is from the next 6 to 12-month perspective.
Where is it that you're most cautious right now sectorally?
Yeah, so one of the sectors that we've been cautious on, or underweight on is IT services. The sector's done very well, by the way, over the last 3 months. The numbers reported by some of the companies were, I would say, just mildly better than what the market expectations were. But the stocks have reacted, in a very, very strong manner. We think the small positive surprise that was visible in the June quarter numbers is, very well baked into the numbers now, into the stock prices, I mean. And, therefore, that is, one sector which we will continue to stay on the sidelines, will be cautious there. I would say, just at the margin, some of the select, PSU names, which have also run quite hard. I would say, probably, could be a bit on the sidelines on some of those from the short-term perspective. Yeah, I guess, and then, again, as I said, from a short-term, medium-term perspective, some of the select mid-caps and small caps as well. So those are broadly the three segments where, we will be cautious at this point in time.
Capital goods, that is the rara bull market which is on. But frankly, you'll track it much more than I do. But prima facie, if I look at L&T, they missed the estimates for 3 out of 4 quarters. If I look at the numbers from Siemens, similar story. But Thermax is no different. ABB is no different. So these capital goods stocks are actually now missing estimates, not beating estimates. Then valuations are stretched. And private sector capex is not picking up. So is there a reason now one should actually start taking chips off the table or book 10-15% profit out of the good machinery stroke capital good stocks?
Which is what we have done, Nikunj, in our own portfolios, that some of the, especially the mid-cap, small-cap names in the industrial, the capital goods sector, as you mentioned, also some of the real estate sector. So we have actually taken some money off the table in some of the mid-cap, small-cap names, in these segments. But Nikunj, I don't agree with your thesis that the private sector capex is not happening. Actually, I can give you a lot of data which actually shows that the private sector capex is actually on an upswing as we speak. In fact, barring just one sector, which is refining and petrochemicals, I think all other sectors, be it steel, be it cement, to some extent even autos, we are seeing a lot of private sector money coming into infrastructure sectors like power and airports and seaports. So I think it's a misconception in my view that the private sector capex is not picking up. According to me, we are already seeing the signs of uptick there already. In fact, the recently reported data by the RBI, which actually collates the data from all the banks in terms of the private projects funding, where the bank, some of the banks has approved those projects, is showing a remarkable 20% CAGR from pre-COVID levels. And the last 2 years, YY numbers are up almost 50%. And this is private projects approved that I'm talking about. So I personally believe that that's I think it's a misconception, barring one sector. The other sectors of the economy are seeing private sector investments already coming through. But I'll agree with your broader thesis that given the combination of valuations, the excessive retail enthusiasm on some of the stocks, I think probably it makes sense to turn a bit cautious here from a 6-month to 12-month perspective.
So, Mahesh, if you have to, let's say, bet on private sector capex versus government capex, next 12 months to 24 months, where do you see better scope of outperformance? If you have to split it in a very broad manner. Private, I'm just, again, breaking it for our viewers. When I say government sector capex, I'm talking about railways, defense. When it comes to power sector capex, I'm talking about machinery, energy, metals, and to some large extent, engineering companies.
Yeah, so from incremental perspective, my belief is that the government has done the heavy lifting in the last 4 or 5 years. When the private sector money was not really visible on the investment side. And I think if you just look at the budgeted numbers, the government capex as a share of GDP is at an all-time high. And my sense is that you will probably not see the kind of increases in the government capex spending in the next 2 to 3 years as compared to what you see in the previous 2 to 3 years. And the private capex is doing well. So, if I were to take the call, I would, from an incremental news flow perspective, will be more positive on the private sector capex than the government sector capex, because the government has already done a lot. And I think it will be fair for the government capex to now take a bit of a breather. And when I say breather, I'm just saying that it will probably move in line with the GDP. And so it will still grow, but not grow as a share of GDP. Whereas private sector, I think probably will grow as a share of GDP, as well. And mind you, the government also has to, sort of keep in mind the fiscal deficit target as well. So there are those other constraints, which also the government will have to keep in mind. So yes, at the margin, I would now prefer private over government sector capex plays.
Okay. Mahesh, when you say you don't like IT, why is that? Because most of the IT companies are talking about recovery. The fear of AI is now over. In fact, they've started hiring also. So yesterday's story was AI disruption, but will that be tomorrow's trend?
See, the thing is, AI is definitely, a very strong emerging factor, which we will need to keep in mind. Sometimes we see over enthusiasm, sometimes, we see expectations moderating. But my core thesis is not so much centered around AI. What I believe is that, when we're talking about the rate cuts in the US, the Fed is looking at maybe as much as 100 basis point rate cuts this year, maybe another 100 basis point next year. And while the expectation has gone up on that front, we have to look at the basic cause as to why the Fed is doing that, right? And the reason why they are doing it, because there is weakness in the US economy, and the weakness is increasing, and that's why the Fed is getting concerned, and therefore they want to prop up the economy. So all these rate cuts, etc., will eventually lead to the outcome that the Fed wants, which is the eventual recovery in the US sort of economy and discretionary spending, etc. But that's not what it is today. So my core thesis is that given the expected weakening of the US economy going forward over the next 6 to 12 months, and maybe we'll see the signs of green shoots maybe after 18 months or so. But in the near term, I think we are looking at an environment where the demand outlook is not going to look that great in my view. And the stocks are already factoring in. I mean, stocks are already up a lot in the last 3 months. So a lot has been factored in very quickly.
Okay. Your light's going off. I guess that's cue for us to let you go, Mahesh. Good speaking with you as always.